Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Investing Fundamentals. Investing fundamentals are a crucial aspect of financial planning, especially for those seeking to build a solid foundation in business strategy. Understanding the core principles of investing can significantly impact an individual's or a business's financial health. Investing involves committing money to an endeavor with the expectation of obtaining an additional income or profit. The primary objective of investing is to generate returns that outpace inflation, thereby increasing purchasing power over time. The first fundamental concept in investing is understanding the relationship between risk and return. Risk is the possibility of losing some or all of the original investment, while return is the gain or loss made on the investment. There is a direct correlation between risk and return. Generally, the higher the potential return, the higher the risk. This principle is essential for investors to grasp, as it influences their investment strategies and decisions. Diversification is another critical principle in investing. It involves spreading investments across various asset classes, such as stocks, bonds, and real estate, to reduce risk. By diversifying, investors can mitigate the impact of poor performance from a single investment on their overall portfolio. Modern portfolio theory, developed by Harry Markowitz in the 1950s, emphasizes the importance of diversification in achieving an optimal portfolio that balances risk and return. For instance, during the 2008 financial crisis, diversified portfolios were generally less affected compared to those heavily invested in one sector, such as real estate. The time value of money is another fundamental concept in investing. This principle asserts that a dollar today is worth more than a dollar in the future due to its potential earning capacity. This concept underlies many investment decisions, as it helps investors evaluate the present value of future cash flows. Compounding, which is the process of generating earnings on an asset's reinvested earnings, is a powerful illustration of the time value of money. For example, investing $1,000 at an annual interest rate of 5% will grow to approximately $1,628 in 10 years, assuming the interest is compounded annually. This growth demonstrates how money can grow over time when invested wisely. Understanding different asset classes is fundamental for any investor. Stocks represent ownership in a company and provide investors with voting rights and potential dividends. They are typically considered high-risk, high-reward investments. Bonds, on the other hand, are debt securities in which the investor loans money to an entity that borrows the funds for a defined period at a fixed interest rate. Bonds are generally considered safer than stocks, but offer lower returns. Real estate investments involve purchasing property to generate rental income or capital appreciation. Each asset class has distinct characteristics, risks, and potential returns, making it essential for investors to understand them to build a balanced portfolio. Market efficiency is another critical concept in investing. The efficient market hypothesis, proposed by Eugene Fama in the 1960s, posits that financial markets are informationally efficient, meaning that asset prices reflect all available information at any given time. According to this hypothesis, it is impossible to consistently achieve higher returns than the overall market through stock selection or market timing, as any new information that could impact a stock's price is quickly and accurately incorporated into its price. This concept has significant implications for investment strategies, particularly for those considering active versus passive management. Passive management, which includes strategies like index investing, aims to replicate market performance, while active management seeks to outperform the market through various investment decisions. Behavioral finance explores how psychological factors influence investors' decisions and market outcomes. Traditional finance theory assumes that investors are rational and markets are efficient. However, behavioral finance recognizes that investors often exhibit irrational behavior, such as overconfidence, herd behavior, and loss aversion, which can lead to market anomalies and deviations from expected outcomes. For example, during the dot-com bubble of the late 1990s, many investors irrationally drove up the prices of technology stocks based on speculative behavior rather than fundamental value, leading to a market crash when the bubble burst. An understanding of valuation methods is also essential for investors. Valuation is the process of determining the intrinsic value of an asset. Common valuation methods include discounted cash flow analysis, which estimates an investment's value based on its expected future cash flows discounted to their present value, and relative valuation, which compares an asset's value to that of similar assets using metrics like price-to-earnings ratios. For instance, a company with a P/E ratio significantly higher than its industry peers might be considered overvalued, suggesting caution to potential investors. Investors must also be aware of the impact of macroeconomic factors on their investments. Economic indicators such as interest rates, inflation, and GDP growth can significantly influence asset prices. For example, rising interest rates typically lead to higher borrowing costs for companies, which can reduce corporate profits and negatively impact stock prices. Conversely, lower interest rates can stimulate economic growth by making borrowing cheaper, now potentially boosting stock prices. Understanding these macroeconomic factors enables investors to make more informed decisions and anticipate potential market movements. Tax considerations are another important aspect of investing. Different investments are subject to various tax treatments, which can affect an investor's after-tax returns. For example, dividends from stocks may be taxed at a different rate than capital gains from the sale of those stocks. Additionally, tax-advantaged accounts like individual retirement accounts and 401 plans offer tax benefits that can enhance long-term investment growth. Investors should be aware of these tax implications and consider them when making investment decisions to optimize their after-tax returns. Finally, ethical considerations play a role in investing. Socially responsible investing and environmental, social, and governance criteria have gained prominence as investors increasingly seek to align their investments with their values. SRI involves selecting investments based on ethical, social, and environmental criteria, while ESG criteria assess a company's performance in these areas. For instance, an investor might choose to avoid investing in companies that produce fossil fuels or invest in companies with strong commitments to sustainability and corporate governance. These considerations can influence investment decisions and potentially impact returns, as companies with strong ESG performance may be better positioned for long-term success. In conclusion, investing fundamentals are essential for building a robust financial strategy in business. By understanding the relationship between risk and return, the importance of diversification, the time value of money, different asset classes, market efficiency, behavioral finance, valuation methods, macroeconomic factors, tax considerations, and ethical investing, investors can make more informed decisions that align with their financial goals. These principles provide a foundation for developing a comprehensive investment strategy that balances risk and return, optimizes growth, and aligns with personal or organizational values. As the financial landscape continues to evolve, staying informed and adapting to new information and trends will remain crucial for successful investing. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.